Well, my next guest says the federal budget's proposed changes to capital gains tax and negative gearing are already having an impact on housing market sentiment. So let's get into the details with Anthony Lundale from Equilibria Finance, who joins me now. Good to see you, Anthony.
Nice to be here.
So we've spoken once already about the budget, but how are you seeing existing clients reacting, and how do you think it's going to affect the overall property market?
Yeah, well, the property market was facing headwinds before the budget. May's data showed that nationally growth was 0%, and that doesn't really factor in the budget and the potential changes there, but we're absolutely seeing a shift in sentiment. The headwinds that are being faced were obviously the higher interest rates as well as affordability pressures. With the change in policy, or with the budget and potential change in policy, I should say, we're absolutely seeing a shift in investor behaviour. Existing investors particularly are now looking at, do they hold their current property to maintain the capital gains tax and negative gearing grandfathering arrangements. So that's going to impact liquidity in the market. That's going to potentially impact rental stock in the market. Basics of supply and demand, that could impact rentals. Rental growth's already at 5.9% nationally. Vacancy rates are tight. In terms of new investors, there's two camps there. There's investors who had a pre-approval in place to purchase. Some of their strategies are totally upended. Some of those investors now are looking at purchasing capacity 20-30% below what they could do, or in fact not purchasing investment. Others are looking at, do we go for a new build? I think we've got to look at those new builds though on two fronts. One, they're potentially going to be in competition with the first home buyers. The government's saying that they're trying to solve the housing crisis with all of what they're trying to do in this budget. Secondly, for an investor looking at a new build, they're much more going to be looking at chasing higher rental yields, because the capital growth and the CGT changes are going to impact them on the way out. So again, that could see a pressure on rentals as well as a pressure on potential first home buyer stock. So a lot of headwinds, both from the demand side with affordability, the supply side was already battling, and also some of the investor behaviour is already changing.
Yeah, and that's what's interesting, isn't it? The impact here on sentiment. So what about, new investors or those with approvals?
Yeah, new investors and those with approvals are, as I mentioned, they're shifting. Do we look at what's the viability or feasibility of actually purchasing a new build, where they'll get the negative gearing benefits, they'll still receive the pre-budget benefits. A lot of those new builds are units that may provide less capital growth over time, and they'll be chasing higher rental yields. A lot of other investors are in fact rethinking their strategy. My instinct is we're going to see a drop in investor behaviour of maybe 20 or 30%. And investors generally aren't going to be chasing those properties that historically were negatively geared. Even in the established space, they're going to be looking at those properties now that provide the higher rental yields, or where they can get the higher rental yields. I think we're going to see a lot of pressure on rentals, irrespective of what's happening on the demand side. Supply is just not keeping up. So I think there's a lot of headwinds for those people renting and trying to rent. We're also seeing first home buyers who were using rent vesting as a strategy. Buy a property, get some capital growth over 2 or 3 years, sell it, and then buy where they want to live, rethinking that as well. So it's not really helping those buyers that the government claims to be helping.
And therefore, there's all this talk that house prices could fall, maybe something like about 10%. You touched on potential rental rises there, and what would that do, a big drop in house prices? Yeah,
look, I think there is talk of house prices falling, and as I said, we're already seeing a softening in the market, particularly that higher quartile where affordability is a real challenge. I think we're going to continue to see on the demand side, with affordability challenges, the policy settings from the budget, we're going to see demand continue to weaken. I think the only thing that will sort of save it from a major correction of those 10% is the fact that supply is limited. There's still enough demand out there to keep prices, particularly in that lower $1 to $1.5 million quartile strong. But we're definitely going to see a lot of pressure on renters, and we are going to see an easing of the market, particularly from investors pulling out. even first home buyers, there's now concern around negative equity. If I access the 95% first home buyer schemes and the market's falling, am I going to be in negative equity? So there's a lot of concerns from new home buyers now, as well as investors in a falling market, as distinct from a market that is growing more sustainably.
Yeah, okay, so what sort of percentage would you give maybe that rents would be hiked by, or is that sort of hard to guess?
Look, we've been seeing rents, we've been seeing pressure on rents for a number of years. We had vacancy rates below 1%. I wouldn't be surprised if we see rentals up maybe 1 to 2% over the next 12-month period. There's essentially going to be less liquidity from investors. They're going to be holding their stock. And for new investors, they're going to be that rental yield's going to be a lot more important than it was in the past. And we're already seeing discussion and landlords passing on higher rentals. So I think we're going to see some real pressure on rents. Whether we start getting growth, as I say, around 7-8% annualised, I think is a real possibility.